What is an EPS accretive acquisition? Imagine you have a small business that's making $1 million profit, and just like many small businesses, has one owner and one share. The earnings per share, known as EPS, is that 1 million divided by one share, which is still 1 million. Typically, a small business might be valued at 3 to 5 times its earnings, which means the 1 million profit is worth 3 to 5 million to the owner if they can find a buyer. However, let's now consider a publicly listed company known as a PLC in a similar situation. Let's say we have a PLC doing $1 million in profit, but because it's publicly listed, it typically might have about 10 million shares divided by a number of shareholders. In this case, we have the 1 million profit divided by 10 million shares, which makes your earning per share just 0.1. But valuations of PLCs are much more than that of small businesses for several reasons, including what is known as the liquidity premium. Investors will pay a premium to be able to quickly and easily sell their shares, something that is not possible if you own private shares. In our example, our PLC is trading at 20 times earnings, so is valued at 20 million. Now imagine that our PLC decides to acquire the small business using its shares. In our example, it will create 5 million new shares. In order to pay the founder, it creates 5 million new shares and now owns 100% of the business. Our PLC now has 2 million of profit. Its original 1 million profit and the additional 1 million from the small business. That 2 million divided by the 15 million shares shows a higher earning per share of 0.133. The valuation is still 20 times earnings, meaning the total value of the PLC is now 40 million. As regards the question of dilution, the existing shareholders of the PLC have been diluted in percentage terms, but the value of their shares has gone up. Percentages are important in small businesses, but in the PLC world, the value of your shares is way more important. If the companies the PLC acquires continue to be independently run, the PLC can keep adding more and more companies to the portfolio, as long as each acquisition is EPS accretive, meaning the multiple paid for small business is less than the multiple the PLC is trading at. The value of all existing shares will continue to increase. One final bonus to this model. Because the PLC uses its own shares and not cash to fund growth, it can return the profits it makes to all shareholders in the form of dividends. Assuming it can keep adding businesses, you as an investor end up owning a fast growth stock that also pays a dividend yield. This is a rare combination. If you would like to get more information about this model, then don't hesitate to contact us at mbhcorporation.com.